I'm hearing two things from you. You're saying that the economy is doing well, but there's this sense with people that the economy is actually starting to slow now, and people are more and more. There's talk about recession. And even the Fed thinks the downside risks are rising. So is the economy over the next year, between now and the end of next year, you think GDP growth is going to hold steady and the unemployment rate? Could you talk about just how do you see the economy evolving over the next year?
So I think, and my colleagues and I think all think, that the most likely case is for continued moderate growth, continued strong labor market, and inflation moving back up to 2%. And I think that's, by the way, widely shared among forecasters. The issue is more the risks to that. You have downside risks here, and we've talked about them. It's that global growth will have an effect on U.S. growth over time, less so than for many other economies, but still, there's a sector of our economy that's exposed to that. Trade policy uncertainty also has apparently has an effect. And you can see some weakness in the U.S. economy because of all that. But nonetheless, so the job of monetary policy is to adjust to both to insure against those downside risks, but also to support the economy in light of the existing weakness that we do see. So as I mentioned, we don't see a recession. We're not forecasting a recession, but we are adjusting monetary policy in a more accommodative direction to try to support what is, in fact, a favorable outlook.
And the inverted yield curve that we hear is the bond market signaling recession. What do you is that? So that signal is not pertinent to you, or where do you?
No, we do. So we monitor the yield curve carefully, along with a wide range of financial conditions. We don't. It's not. There's no one thing that is dispositive among all financial conditions. The yield curve is something that we follow carefully, and again, based on our assessment of all the data, we still think it's a positive outlook. So just to talk about the current situation, you saw long-term rates move down a whole lot and then retrace 2/3 of that move in the space of a few days. So I think what really matters for all financial conditions generally is when there are changes, material changes that are sustained for a period of time. So, but why are long-term rates low? There can be a signal about expectations about growth there for sure, but there can also just be low-term premiums. For example, it can just be that there's this large quantity of negative yielding and very low yielding sovereign debt around the world, and inevitably that's exerting downward pressure on U.S. sovereign rates without really necessarily having an independent signal. Nonetheless, that is a signal about weak global growth probably, and weak global growth would affect us. So global capital markets and the global economy are quite integrated. So this is something we pay careful attention. We're not going to be dismissive about the yield curve, and I think you can tell on the committee there's a range of views. There are some who are very focused on the yield curve, others not so much. From my perspective, you watch it carefully, and I think you need to be asking yourself a lot of questions if the yield curve is inverted as to why that is, and how long it's sustained.